I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. It is May 24th. It's Tuesday, and this is the interest rate update for the Mortgage Brothers show. And before we get going, this is not financial advice. Why is that, Tom?
That's right, because we're smart, but we're not that smart.
That's right. This is for informational purposes only. And going right into it today, the 30-year fixed conventional loan at 4.875. It's the same as yesterday. Across the board, nothing's really changed. The 15-year fixed today at 4.125.
The 5-year ARM is the exact same change as yesterday, or same rate as yesterday, 4.49. FHA 30-year 4.5, and the 30-year VA 4.5. So we could probably just use the slide from yesterday.
That's
so
right.
just go back to yesterday's podcast.
Okay, so there's all these loans that we've just quoted, these rates come with no points. There shouldn't be any lender points on this. And it's really important because when you're looking at interest rates, you're going to notice that there's going to be other people quoting oftentimes points. And 1 point equals 1% of the loan amount. So if you have a $400,000 loan amount, 1 point equals $4,000 of extra costs.
Right, points. Everyone talks about points. That's all it is. Literally, a point is 1%. Now, you could have fractional, but typically, that would be a much longer podcast. But when people say a point, they literally mean 1 point. So definitely look at the fine print. Make sure that there are no surcharges, there are no extra fees, and no discount points.
All right, and be sure to subscribe and like the channel because and comment below. And we're going to be going into, what's on a lot of people's minds, and that's all about, recessions and whether or not it's a good time to buy a home or not. And a lot of people, when they think recession, they think, my gosh, this is an opportunity to either sell my house or wait until the recession's over and then go buy a house, or, I'm going to go time the market.
Yeah, we actually have not many, but we've got a few borrowers who are literally sold and are living with mom and dad, and they are waiting for the market to correct. That's a very, very difficult position to put yourself in. Is there a chance? Obviously anything can happen. But boy, like we've always said, it's not timing the home, but it's timing the home. It's really, really important that our listeners understand that not in all recessions do home prices, decrease.
That's right. So we're going to go right into the data to show you what recessions have done to home prices before in the past. All right. So before you just go and sell your house or you try to time the market, think of this. In the last 48 years, there have been 7 recessions. And did you know, Tom, in only one of those recessions did we see significant price decreases, or really any price decrease at all in home prices?
And what was different about that recession compared to all the other ones?
Yeah, that was the recession in 2008 to 2009 that was caused by the real estate. Real estate caused the recession.
That's a very important fact that a lot of people don't talk about.
It was the first time we ever saw the recession caused by real estate. It was the mortgages and how they were underwritten, right? Everybody, or a lot of people remember.
The subprime, I think people always talked about that.
So you look at all these prior recessions, home prices, even if they were relatively flat, and some people, and maybe in some local areas, in the country, people did see maybe some price decreases or really no appreciation. The idea that, I'm going to time the market, I'm going to not buy my real estate because everyone's thinking of this big recession, the 2008 recession, 2009. That's seared into our memories because we're all the ones who are really alive and working out there. Our families, we're in our prime.
Yeah.
Most people who, or whatever, everyone's lived through this. Most people have lived through the 2008 recession. So that's fresh in their mind. Now let's go right to the next. What makes this different, aside from that fact, right, that we just discussed? That today we have very, very few homes available on the market. Back then, there were 2 million homes vacant and on the market for sale in 2008.
And who creates vacant homes? A lot of it is the investor. The investor is actually holding the home, wanting to rent it, and when values start to shift and they don't have renters, all of a sudden these homes become vacant, and that impacts all the homes where there's actually primary occupancy. So vacancy is really important. You're thinking, well, I just live in my home. How can it be vacant? Well, homes can be vacant if they are being purchased in order to rent.
Right. And it's going to go to our next slide here. But yeah, so only 30. Our availability today for homes that are vacant on the market are only 33% of what they were in 2008. Okay, on this next slide, we asked, we of course will we repeat the 2008? What's the difference? This next slide, we're talking about what you were just saying about rental properties, vacancies of rental properties, landlords. We see that in 2008, 10% of all investors' properties were vacant.
Yeah. Homes, in total, which a lot of the vacancies would have been caused by the investors. So that's saying 1 out of every 10 homes. So if you had a neighborhood of 40 homes, 4 of those homes are empty. I mean, there aren't many communities with just 40 homes. I actually personally lived in a neighborhood that probably had 30. It'd be like 3 of them empty. That's a lot.
That's a lot.
So that was a big number. Look at that compared to where we are today.
Yeah, you can see we're at just about 6% vacancies today of all rental properties, which is very low. And look historically, this chart goes all the way back to the 1955. So in 2008, that was a lot different, very different. It was on the high end of in the last 50 years. So very different today. A lot less rentals available. That's why it's hard to find a rental. That's why rental rates are going up.
And the reason when we talk about vacancies, it's just supply and demand. We're always going to have buyers out there, but when you have sellers, because the home is vacant, now let's get it on the market and let us go and sell it. When you start to have too many, homes for sale, buyers have all these choices, and instead of paying top dollar for them, they'll pay less. So that's why vacancies are so important. It just simply feeds into the supply-demand notion.
That's right. Okay, so we talked about this leading to the 2008 recession. We've just kind of a recap here, but inventory of homes was high. Today, the inventory of homes for sale is low. Something kind of to refresh everyone's memory that in 2008, leading to 2008 recession, if you were to ask the average homeowner, what's your 30-year fixed interest rate on your home? You just ask the average person, they would say about 6.3%.
Wow, that's surprising to me.
And if they were to sell their home and go rent their house or something very comparable, it would be the rental payment would be a little bit less or equal to, meaning their mortgage payments are a little bit higher or equal to the comparable home rent. Today, if you asked a homeowner, hey, what's your interest rate on your home? They're going to tell you 3% or something. They're going to say, I have this low interest rate I locked in last year, 6 months ago, 2 years ago. Within the last 24 months, people have been locking in these low rates, and their mortgage payments are a lot less than what it would cost to rent their home. Absolutely. So the reason why this is all important, because, hey, why would this person right here today want to put their home on the market and rent their house? Okay, that kind of goes to why are they? Because we need to have inventory. The whole thing, we need to have inventory in order for prices to go down. So next.
Okay, but just go back to that slide. So the fact that their mortgage payment is less than what they could rent their home for. Well,
I'm just saying that they're not going to be motivated to list their home for sale. The vast majority of people in the U.S.
would rather hold it and rent it rather than sell it.
That's right. Yeah. Because in order for us to have, how are we going to get more inventory of homes for sale? And inventory of homes for sale will cause prices to go down. Well, you need a lot of people to sell their house. Well, why are they going to sell their house? They're not going to. If you're in your home for at 3%, it's going to be you have to absolutely hate your home or have to leave for a relocation of your job or something like that. So it's part of the argument against home prices going down.
Yeah.
Okay. Then leading into 2008 recession, underwriting standards were really low, which we discussed because it was the primary cause of the recession. Loans were bad loans. Today, the underwriting standards are high. Debt ratios and income guidelines have been held to strict rules.
Because they learned from 2008. They were like, whoa, we're not going to go back to that, those days.
Exactly. And so all the loans that are out there right now, they're not, if people lose their jobs, there will be foreclosures. But back in 2008, you didn't have to lose your job. You just didn't even have a job potentially. Many people didn't even have a job, or they were just no verification of income.
Yeah.
So-
Just tell us what you make over the phone.
Yeah.
Oh, you make $1 million. Great.
So these homes today are not really, there's not a high risk of them going into foreclosure because foreclosures would cause more inventory and cause prices to go down. So that we're not really threatened by that. And then in 2008, there were some corporations that owned some single family residences in their rental portfolios. But today there are many corporations, REITs, BlackRocks, these big LLCs, and also home builders are now into this business of building homes and renting them. I mean,
Wow.
they're all kind of following the same suit. This idea that single family residences are good for big businesses, big rental portfolios. I mean, pension funds are buying shares of REITs, of BlackRocks, all across. I mean, so no matter where you are globally, you
Yeah.
can buy a part of these REITs, and they're buying the home next door to you and renting them.
Yeah. And why are they buying them? Because they know they hold value.
Yes.
And that's the reason for all these slides to show is that, again, purchasing a home is going to be your best investment that likely you'll do your entire life. And I think these corporations are actually just proving it right now.
That's right. And so that's smart money. If you follow the smart money, you want to own real estate to hedge against everything else. So the bottom line, and kind of just in the end here, do home prices go down in recessions? They have, and they always can. It's impossible to predict what will happen. And we just basically say here as a disclaimer, this is only our opinion, but based off of this data, we do not believe that home prices will fall. And if they do fall, they won't even be significant or short-lived. This is very different than 2008. So be very careful. That's what we're telling ourselves.
Yeah, and we're still coming off the woes of the pandemic. I mean, there's still lockdowns, in certain countries, and so that supply chain is still an issue. And when you have those types of factors, again, that people are seeking a safety and refuge into things that they can touch. Those are homes.
Right.
So another huge factor. I don't know when that's going to subside, but that's a very big piece of this equation.
Okay, so. Just really quick here, if home prices are going to potentially be threatened to go down, we would have to see, we've been talking about a massive shift of inventory. If you see a ton of homes going on the market, if that happens, then prices are threatened. If you see rental values start going way down, so let's just say rent today is at $2,500 a month, and you start seeing it going down to $2,000 or $1,500, well, that's a problem. Those are going to be like your early signs.
Yeah. So, and I want to say this too, because our listeners, a lot of our listeners, we're very average guys, and what we want to do is we want to talk to, the most typical person out there. You guys are not looking to invest in homes. I know you've been taught like this is what you're going to do, but what we're really talking about is buying a home, living in a home. If you want to purchase your primary home and then go and invest in other real estate, this is when a lot of these data points become important to you. But I was trying to think of an example. It's like I'm waiting to get a haircut because you hear one of the barbers is going to be, issuing coupons. You just can't wait and have your hair grow super long while you're waiting for a haircut. So again, for our listeners, buying a home, living in a home, getting married, getting separated, having children, moving a job, these are things that are just part of life. So do not be afraid. A lot of these data points will be more for investors. And you can't help but be an investor when you actually own a home. But again, your pure focus is having a kitchen, having a bathroom, having a bedroom. And I just thought that was important to get out there.
Okay. And again, do your own research, obviously, and do not listen to the media. Take what we're saying, of course, and just double check.
Are we the media?
We're like a subset of
subset.
Yeah. Subset. Yeah, what we have is our own little channel here. We're like the tiny little media empire with our dozen listeners. Okay, but everybody, have a great day. We'll be back tomorrow. Take care.
All right, thanks, folks.
Hey guys, thanks for listening to the Mortgage Brothers podcast. Please let us know if you have any questions you'd like us to answer. You can email your questions to team@azmortgagebrothers.com. And be sure to ask us for a free quote on your next mortgage. We'll be sure to give you personalized service and help you through the whole process.
Signature Home Loans LLC does not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. Signature Home Loans, NMLS 1007154, NMLS number 210917 and 1618695, Equal Housing Lender.